Hey everyone, welcome back to the show. Happy Friday. Hopefully you all have a great Memorial Day weekend planned. I'm going to talk about how option prices drive implied volatility today and how implied volatility drives standard deviation. So we're going to really break down the relationship between these three things. I think there's a lot of great takeaways and a lot of misconceptions out there. So we're going to break all those down today, and we're going to really break all these down and show you exactly what we're looking for when we're trading with options. So let's start out with really defining implied volatility and how prices drive implied volatility. A lot of people believe once you learn about implied volatility that implied volatility is something that we can actually find out or something that we already know without using any other options, but that's actually not the case. So with the Black-Scholes model, we actually are taking all the other inputs of that Black-Scholes model and we're attempting to solve for implied volatility by using those inputs. So price is probably one of the bigger ones, so we're going to focus on price today. So if you believe and think about prices and how option prices change and how that reflects upon implied volatility, it starts to make more sense. So we know that option prices are made up of intrinsic value and extrinsic value. Intrinsic value is really just the real value at expiration. So when options are in the money, or when calls are below the stock price and when puts are above the stock price, both of those scenarios are in the money scenarios, and both of those scenarios have intrinsic value at expiration. When I'm looking at a call option, if I can buy 100 shares of stock for a lower price than the market is giving me right now, that's going to have intrinsic value. And with puts, if I can sell shares of stock at a higher price than the market is giving me right now, that's also going to give me intrinsic value. But when we look at extrinsic value, that is a number that is derived from time and volatility. So the more time we have on an option expiration, the more that's going to be priced. If you think about something like insurance, which if we're looking at a long put against 100 shares of stock, basically what we're doing is completely insuring the losses on those shares if we were to see them. So what I'm doing with a put is if I were to buy that, I would be buying insurance on my shares. So the more days I have until that expiration of that contract, it's going to be worth more. So if I'm looking at a 30-day expiration and comparing it to a 60-day expiration, the 60-day is definitely going to be worth more because I have insurance on those shares for 60 days rather than 30. But another thing that comes into play other than time is that implied volatility. So when we're looking at solving for these metrics and solving for how these things change the option price, what we really need to know is that it's the other way around. So option prices drive implied volatility. So if there's a lot of speculation in a certain underlying, maybe there's a big news announcement like you might see with earnings, where earnings really tends to drive up implied volatility, and you'll see implied volatility rise around earnings because of that speculation. So time doesn't change. We're not really adding any time or subtracting any time, but what does change is that speculation, and we can wrap that around the implied volatility. So when people are buying options, if you think about it like supply and demand, when people are buying options, that's going to drive the price up of those options. If people are selling options, that's going to drive the price down, just like the normal stock market. So when we see options that are priced at a lower level, we're going to see a lower implied volatility because of that. Because again, with the Black-Scholes model, we solve for IV using these other inputs. But if we see the option prices starting to gain value and all other things are being held constant, so if we're not seeing an increase in intrinsic value and there's really not much of a passage of time, we can attribute that increase in the options value to an increase in speculation. And because of that speculation increase, we're going to see a larger implied volatility. So when we're looking at implied volatility, we're just thinking about what the implied move of that underlying is over a course of time. So on the next slide, we're actually going to talk about implied volatility, and we're going to really break that down for you. So really what we need to know when we're interpreting implied volatility from an options trading standpoint is just understanding that it is something that is implied. We're not looking at historic volatility, which is really a backwards looking metric where we're measuring how much that underlying actually moved. We're looking at implied volatility, which is forward looking. So implied volatility is the annual implied move of an underlying with a 68.2 probability of happening. So that is one standard deviation. 68.2% of occurrences. When we capture that amount of occurrences, we're capturing one standard deviation, which we'll get into in a little bit. But here I've got some examples for you. So implied volatility here, let's say we've got a stock price at 100. If I have an implied volatility of 20%, then I would have a one standard deviation range of 80 and 120. So all I'm doing here is taking 20% of that stock price. So the stock price is at 100. 20% of that would be 20 points to the downside, which lands me at 80, and 20 points to the upside, which lands me at 120. So when we're looking at implied volatility, this basically states that with a probability of 68%, this underlying could potentially move between 80 and 120 if we have an implied volatility of 20%, and that's for a course of a year. So as you can see, it's a pretty small value when we're looking at and thinking about how much an underlying can change in price over the course of a year. 20% isn't too high, but I want to compare it to a much higher IV at 50%. So let's say we're looking at a different underlying that's trading at $50. A 50% implied volatility would indicate that this underlying could either lose half its value and go down to 25, or gain half its value and go up to 75. So this is a much higher implied volatility. And one interesting thing I want to point out is that this right here is a 50-point range. So even though this stock price is half the amount of this one, we've got a 50-point range here and only a 40-point range here. So that's the power of implied volatility. And when we see these high levels of implied volatility, we're normally going to be seeing a higher price premium in those options, because the fact that this underlying could potentially, or the implication is that it could move down to 25 or it could move up to 75. So because there is that speculation, a lot of people are going to be buying options, whether they're hedging their positions. So if they're hedging long stock, maybe they're buying puts. And if they're hedging short stock, maybe they're buying calls. Or maybe there's just people out there that are speculating on these implied moves. So they're just purchasing options, which is going to drive up that implied volatility, which is why you would see it at some level like this. But really the key is understanding implied volatility in terms of standard deviation. So if we think about implied volatility, there's two metrics that we use to put context around that implied volatility. Number one, and the most basic, is IV rank. So IV rank, we're really just looking at the high of implied volatility over a certain time frame and the low of implied volatility, and we're measuring where the implied volatility is at now. So let's say we had an underlying that had a low implied volatility of 50% and a high implied volatility of 100%. So this is a pretty volatile underlying. Let's say right now that implied volatility is at 75%. It's right in between that range, which would give it an IV rank of 50%. So that's one way that we can use an IV rank metric or an implied volatility metric to put context around implied volatility itself. But what we really need to focus on is standard deviation and how that applies to option strikes. So let's go on to the next slide and we'll figure out how this all works together. So when we talk about implied volatility, really what we're looking at is that implied move of the underlying. And standard deviation really is just a way to put context around implied volatility using those strike prices of the option chain. So I've got some numbers here listed in the upper right corner, which are very helpful to remember. So when we're looking at one standard deviation, if we're looking at options when they're out of the money or in the money, we're looking for these probabilities here. So if I am looking at probability of being out of the money if we're on the Dow platform, when I'm looking at one standard deviation, I'm going to be looking for a strike price that has a probability of being out of the money of about 84%. That's going to capture that 68.2% range roughly, because if we look at 84% out of the money, that means it's going to have a probability of 16% being in the money, because it's just the inverse of that. So if we take 100%, subtract 84, we get 16. And if I do that for the put side, I've got a 16% chance in the money. And I do it the same thing for the call side. I have two options that have a 16% chance of being in the money. I add that together, that gets me 32%. Now what happens if we subtract 32 from 100? We get 68. So that's how we get that calculation of one standard deviation and how we really capture that one standard deviation range. So using these numbers, we can easily do that. But really, when it comes down to standard deviation, It's just a quick way to put pinpoints in strikes and really visualize where these probabilities are and where these 1 standard deviation and 2 standard deviation ranges are. So here I've got a low volatility environment and a high volatility environment. So let's look at the low one first. So our stock price, let's say, is trading right at 100 for both of these. In a low volatility environment, if I'm looking at 1 standard deviation, maybe my out of the money put strike would be at 95. So it's only 5 points out of the money, but since it's a lower implied volatility, it's going to come hand in hand with a lower probability of being in the money. So when we're looking at that right here, it's going to be the same to the upside, let's assume. Let's pretend there's no volatility skew at all. It's perfectly equal on both sides. So I'm looking at 1 standard deviation to the downside at 95 and 1 standard deviation to the upside. So if I'm looking at selling a call here, let's say that 1 standard deviation line was at 105. So as you can see, this 1 standard deviation range only covers a 10-point range. So just knowing that right off the bat, I can easily assume that this is a pretty low implied volatility level. So really, when we see implied volatility increase, what's going to happen is we're going to see these strikes go much further out for that same probability. So when we're looking at 1 standard deviation, to capture that same exact probability of whatever we're looking at, so if I'm looking at out of the money, I would look at for that 84% value. So in a higher IV environment, I might have to go all the way down to the 80 strike to reach that 1 standard deviation and all the way up to the 120 strike to reach that 1 standard deviation. So this is how standard deviation works. It really just gives us context around implied volatility from a strike price level. And as you can see, this range is only 10 points, where this range is a full 40 points. So it's 4 times more just from a pretty big increase in implied volatility. And we can get pretty close to probably the same values for these options in a low volatility environment. So let's say maybe I could get $1 for selling this strangle here, where I'm just selling a put at 95 and selling a call at 105. But in a much higher implied volatility environment, I can maybe collect the same dollar, but going much further out. So I can sell the put at 80, sell the call at 120, collect that same value, but really have a huge, massive range of 40 points. And that's the power of implied volatility and why we usually tend to sell premium in higher implied volatility. But let's wrap all this together with some takeaways for you. So the very first takeaway we've got is IV is a living, breathing thing, and therefore standard deviation is too. When we look at underlyings, we'll see implied volatility change. So I want you to imagine when implied volatility is low, those strikes and the standard deviation is going to get much closer to the stock price. But when it's higher, it's going to expand. So the probabilities are going to expand way out into those out of the money options. So every single day we look at it, I want you to realize that implied volatility is changing, but when we place an option and let's say we sold an option in that high volatility environment, we've got those strikes out here. If implied volatility contracts, our probabilities are going to contract as well, but that's great for us because it's going to reduce the option premium in those options. And if we sold that strangle, if implied volatility contracts, which really contracts that bell curve, what we're going to see is we're going to be able to buy back that spread, hopefully for a much lower value and a profit. And again, option prices drive implied volatility, not the other way around. So it's really important to grasp that concept. It's more about supply and demand rather than just looking at implied volatility and realizing, oh, that's what implied volatility is. We're actually solving for implied volatility using other inputs. And understanding this relationship, as you can see, it really helps us understand and realize when there's opportunity, but also it helps us stay away from maybe inopportune moments. So if we have super low implied volatility and I can only get a few strikes away for that 1 standard deviation level, I'll probably stray away and wait for a better opportunity. So thanks so much for tuning in. Hopefully you enjoyed this segment. If you got any questions or feedback, shoot me an email here, or you can follow me at DoTraderMike. We've got Jim Schultz coming up next though, so stay tuned.